Everybody for joining me today. Today, I want to talk about using life insurance and especially the tax-free benefits of life insurance. If you think about life insurance, there's so many opportunities in our planning. We just have to make sure it's all designed correctly. If you think about life insurance, it's like the Swiss Army knife of planning. If you start looking at the areas that we have, let's look at life insurance not just as a death benefit, but as a planning tool. And so as you start coming through on your planning tools and start building, the client's picture, think about putting a puzzle together. We have tax planning, we have estate planning, you have retirement planning and business planning. And there's a piece in the middle there that tends to be forgotten, and that's life insurance. Life insurance can be that Swiss Army knife, that last puzzle piece that really pulls everything together. But as you look at this, we really have to make sure that this fits everything that we're trying to accomplish. Part of this comes back to the design of the policy. So if you think about a policy, most people, when they think of life insurance, the goal is pure protection, maximize the death benefit for the smallest amount of premium that has to be paid in. And if I was to go talk to 10 people off the street, I'll bet you 10 of them would say this is how life insurance really is designed. It's that low premium, max death benefit. And they're not wrong if we're looking at maximum death benefit. But we have other ways to design this. We can keep costs low. We can increase premium, all of that. But if our goal changes and that we want to maximize cash value, well, this is an accumulation design. So with this, we want the maximum amount of cash going into the policy without crossing the modified endowment contract line. If you go past the modified endowment contract line and put too much life insurance into that policy, well, now we've ruined the tax-free access to the cash value. The tax-free death benefit is still there, but we no longer get to access the income and cash value from this policy income tax-free. So there again, policy design is going to matter. What are we going to do to maximize based on the goals of our client? So when you start looking at a policy, think about the tax advantages. We know it's, for the most part, it's income tax-free death benefit. And with that income tax-free death benefit, it's a great tool to be able to pass on to our heirs, income tax-free. And we can also make it estate tax-free if we not wanted to. They're again designing it for accumulation and don't violate that modified endowment contract line, we can have income tax-free growth and income tax-free access to that cash value. Now we can take it through loans or we can take it as withdrawals, just depends on how we want to access that money. I like this. You can access it at any age. I like Roth IRAs, but there's limitations on how much we can put into Roth IRAs. And anytime we're accessing a qualified account, there could be penalties, there could be RMDs if we decide we don't need the money. So when we're designing the policy for accumulation, we can access that when the client wants to, not when the tax code says they can or can't. Now, there's funding limits. These funding limits are the modified endowment contract line. There again, if you want to put in more money, you're going to need a little bit bigger death benefit. So think about that as baking a pie. We want a pie big enough to handle the amount of filling that we're going to put into it. So if we have more filling, you want more pie crust. Same thing if you think about this for a life insurance policy, we just need to be able to grow it the right way. And finally, with the new riders we have, these living benefits, all of these add additional protection for our clients to cover long-term care needs, accessing their policy. If they access too much, there's guardrails being put on so that they can't over borrow from the policy and the overloan protection riders. So all of these riders are going to allow our clients to be able to use the policy more for what they want to be using it. So if you think about it, when you access the policy, you can always take your basis out. So think about the premium you've put in. You can always pull that out tax free. But if you want to access the income in addition to that, and you can do this from day one, you can take a loan against the policy. Now, policy loans are not free money. They're just leveraging against the policy value. So you're borrowing money from the insurance company's general account, and they're going to basically secure that with the cash value of your policy. You can take that as a fixed or a wash loan. That's very predictable. That means that that loan is not going to cost you any money. So you're taking out money in excess of your basis, take it out as a wash loan, and it's like treated almost like a withdrawal. And you're not going to be charged. You're going to be charged interest, but they'll credit that in to make sure, in essence, the interest is washed out. You can take a variable or indexed loan. That allows you to potentially arbitrage. If the policy does better than the cost of borrowing, you're going to make money on the money you've borrowed. Now, just understand, every time you take money out, those loans can, trigger a tax bill if you take too much, or if that policy lapses, the bill comes due. So we want that policy, that death benefit, to carry all the way to death and then eliminate the loans upon death. So there's guardrails in place, there's overloan protections that prevent this. That will, freeze access when you get to the point where you're taking too much out. So the big thing is we want to do annual reviews to make sure that you're not taking out more money than you should. Finally, I look at, some tax traps that we want to avoid. 3 tax traps. Number 1, that we don't want to take out so much money or inadvertently take money out, and that loan balance becomes too high, the policy lapses, that loan balance can become taxable income. So that's a tax trap we want to make sure we don't incur. The modified endowment contract status, that just means, there again, on the design, we don't want to put too much money into this policy that we cross the line, and now instead of it during life being treated as a life insurance policy, you're treated as an annuity. Those are the types of rules that come in, which means you take out your income first, taxable, whether it's a withdrawal or a loan, it's going to be taxable, and you just lose the tax-free access to your money. Death benefit on a MAcc policy is still income tax-free. Finally, that I look at the tax trap. If the owner, insured, and beneficiary, if these are mismatched, so that we have a problem at death, so that it's not going to the right person, the right timing, all of this can become a problem, and we just want to make sure that it's taken care of. So what's the fix? Making sure that we have clear roles, clear goals on what we're doing. We make sure that we're following through on our funding the way it's designed, and we have annual monitoring of the policy. All of these will help us make sure this all stays in check. Finally, the thing that I like to think about this today, do a 60-second policy review. If you only did one thing this week on your policy, do this policy check. Number 1, confirm the goal. Are we designing this? Was it designed, or are we designing it for protection versus cash value versus some kind of hybrid between the two? Confirm the funding. Are we near the MAcc limits? Can we add more premium if we want? There again, if it's an accumulation policy, let's get as much as we can up to that limit. If you're taking loans, review the loan type, the current loan balance, and take into account making sure that that loan is going to be able to be taken care of even in the worst case years. Finally, confirm the riders that are on the policy and understand how to claim those riders if those things ever occur. And then always confirm your ownership and beneficiary and that they align with your estate and business plan. So those are things we can do on an ongoing basis to make sure our life insurance stays up to date, stays current. And remember, we can always improve this as long as you're healthy and as long as it makes sense. So I appreciate everybody getting on. If you have questions, reach out. If not, we'll talk again next week. Thank you.